Lisa and Robert. I'm going to take Robert's question on this first, and then we'll get into Lisa's question. So Robert's question about buying options. Robert says, I usually stay away from high bid-ask spreads when buying options. What is the ideal bid-ask spread criteria you will use to buy single options or trade credit spreads? Well, you already saw that a little bit, Robert. I don't know if you've caught it, but when we were talking about the spread positions there earlier for Lisa, and we looked at the bull put credit spread searches with the 85% probability, I had a percent bid-ask spread filter in there of 50%. That's a starting point. Okay, I also am using a bid-ask spread of $1. I don't want the bid-ask spreads to be too wide. I limit them to be $1, but also 50%, which is a good rule of thumb. What does this mean? It means the bid-ask spread, the difference between the two options is not 50% of the listed bid price. Right? So I wouldn't have a $1 bid and a $10 ask, because that would be way more than 50% on those positions. We're trying to isolate it down to that more broad view. I think 50% is a great starting point, Robert, to use to limit those. If you're looking at higher price stocks to buy calls against, Amazon, Tesla even, Booking.com, I don't even know where they are right now, BKNG, for example, the $1 monetary difference would filter too many out. Amazon's going to have maybe a $5 or $6 difference, maybe an $8 difference. That's okay if we're talking about a bid of $30 and an ask of $36. That's okay. What I don't want to see is a bid of $1 and an ask of 10. And so that's why we're using that 50% limitation. And for the spreads, yes, I prefer it to be less than $1, because what am I fighting for? I'm fighting for essentially nickels and dimes when it comes down to it, to try to get the midpoint. I don't want to be thrown too far off by too wide of a bid-ask spread and not getting the fill price, Robert, that I wanted in that case. So even for long calls, buying calls or buying puts, I think most of our default searches in this case would have that in there. We're just going to take a look. Is this a default? Yeah, Bollinger Bands ones. Yep. 50% bid-ask spread as a starting point. Ernie did put a $1 bid-ask spread in this case as well. I could probably increase that and still be okay and leave the 50% in there. I did have a conversation with a gentleman who trades long calls not too far out extensively. They represent maybe 40, 45% of his portfolio. I think he was 90 to 120 days out in time. His preference was around 33 or 35%. That might be too restrictive depending on what types of stocks you're looking for. Didn't reduce these results too much at all. You still have got some good, reasonable bid-ask spreads in there with lowering it, and it didn't filter too many out. And I'm not saying these are the calls that investor was buying, but again, these are puts, right? Yeah, I'm in the long put, excuse me. But that is another thing to consider. 50 is a good starting point for the bid-ask spread, Robert, percentage-wise. You may not have to worry about the monetary amounts, of course, based on what kind of stocks you're looking for. So if I expand this, let's put this up to $6 bid-ask spread, but keep it at 35%. Do we open up the list? Not much at all. So some of those big high-priced stocks are probably still not coming in, even though we allowed it to go up to $6. Let's go down here to 3. Of course, some of those higher-priced stocks might not be matching the bearish criteria we've been looking for. Yeah, it looks like the highest priced stock on this list is Tetra at 171.93. Oh, Wayfair, there it is, 202. That's not nearly as high as the prices we were talking about, Robert, in that case. But that's the starting point I would recommend. Start with 50%. You're still not comfortable with that, the 50% range difference. Lower it down to maybe 40 or 35% to see if that helps your results. That's the good starting point to look at. And on the topics of long calls now, we'll get to, or long options, I should say. Lisa says, your input on rolling long calls out for more time and rolling up the strike price to save the cost. Depending on what your outlook is and what your goals are for the strategy. What I mean by that is that rolling up a profitable long call, I am going to take, let's see here. Yeah, I know we've got a lot of examples able to use. Yeah, I'm going to take Barry. And we're going to go back 1 month, a month and a half on Barry. Sorry, folks. Let's go to the chain. And I'm going to go back to November 1st. Why not? Let's just see what we have there. Barry should have been around 66. Yeah, okay. So I'll go to, probably would have gone to March, but we're going to use January in this case. All right. So let's say that back on November 1st, we bought the January 65 call at 405 for Berry Plastics when the stock was at 66. Okay, so let's go ahead and put that into the portfolio. Here's another position that was asked about this week that we might get to. But we're going to enter in a long call option for BERY. We'll take the January 65, one contract, November 1st, and our cost midpoint would have been 405. All right, so where are we at now? Not as much as I had hoped. We're essentially at an 84% liquidation gain on the position. Okay, and what are my considerations now? Well, I can close the position and take the profit, Lisa. I can roll it up and keep the same expiration. For example, we could roll the 65 maybe up to the 70. I don't know if I'd go to the 75 with the stock just at $72, but it might have a no risk position going up to the 75 for January, meaning I've gotten back most of what okay, this one wouldn't be, I'm sorry. This one wouldn't be a bulletproof one. We'd need to see 100 or 105, 110% gain in order to see a no risk transaction. But yes, I could very easily roll this up in strike and cancel most of the exposure. What would I have then? I'd probably have a 70 strike call with only a price of $2, cutting the exposure in the market in half. But rolling further out in time, I may do that, but it depends on how close I am to expiration and how much further upside I really feel is going to exist there. And the input on rolling long calls, do we think it's a good idea? Well, I'd say so because it's shown in my rollout opportunities here for this profitable long call position. So when you're tracking those long calls, you can link to the position analysis. And so here, we could see that my new exposure, if I did roll to that January 70 call, would only be 35 cents. If I rolled up to the 67.5, it would only be 205. If I rolled up to the 72.5, I would have a no risk position, but I'm going to have a really low probability now of getting further profit unless I really expect Berry to cross above 72.50 and go into the 75 range in the next few months. Or in the next, what was it, 81 days left? No, we opened it at 81 days. There's only about 40 days left, 42 days. So what is my exposure now, Lisa? My exposure is 405. And we know we've got a profit of 84% of what we expected to make on the position if we close it right now. If I rolled my 65 up to the March 70 call, added an additional 56 days of time, my cost basis would be 205. I'd lower the cost, and now I'd have 98 days that if the stock continued to move up, I could realize higher profit by cutting my exposure in half if I'm wrong and the stock pulls back in price. We'd be selling our existing option for, I'm sorry, what was it? It was about 705 and paying 545 here to buy the new option. So we're taking the profit off the table and we would just have a new risk of $2. And again, if you go further out of the money, you have less cost, so you have less exposure. And going further out in time out to June, well, we're still cutting the cost basis down, but not as much because we have to add much more time value in that scenario, Lisa, to do that. So what does a no-risk long call look like? It looks very similar to a bulletproof married put position, okay, where I now still have a long call. And then remember, this is January. We're selling to close our 65 call for 745, buying 42-day out, still January 72.5 call at 243. Here's my original position on the left in red. And here is my new position, a no risk, no chance for loss long call at the 72.5 strike, with my stock trading roughly at 72. We've got 42 days to hopefully realize more profit if the stock continues to go up in price. We have a guaranteed profit in this case of about $1.98. We get that, we've pocketed that essentially as a credit. That stays in our account. We could make more if it moves up, but we only have 42 days to go. The advantage, of course, of rolling further out in time is reducing the exposure. Remember, if the stock pulls back in the next 10 or 15 days from where it is now, I could lose some of this profit I have. The call is at 7:45. We could sell to close our January 65 call for 7:45. Remember, original cost was 405. So we're pocketing that 340 if we close it. But then in this case, we'd be buying the 430, only have an exposure of 90 cents. Or if we paid 545 for the March 70, we only have an exposure of 205. We gave ourselves 56 days. We give ourselves more time and we cut down the exposure. Those are both pretty good plans going forward, but I still have to have a very strong bullish sentiment on the stock. Otherwise, if I've hit my targets, 84, 85% return, and I can take it off the table early, maybe I just sell to close this one and look for a new call on a stock that I'm more bullish on if I'm not that bullish on this particular scenario anymore. It is a good play. Don't get me wrong. It solves everything we would want to do. We pocket some of the profit, we reduce exposure in the market or cancel it completely, and we still give ourselves an opportunity for further profits if the stock continues on this trend that it's been showing us for the recent time period. But again, depending on your outlook and what you want to have accomplish, that would dictate, is it a good idea for you to do? But of course, you can see it and you can compare the new risks, the new monetary risk or exposure based on what profit is pocketed by simply tracking your position in the portfolio and then going ahead into the position analysis view. The position actions view and then position analysis to see your rollout opportunities on those profitable long calls. In addition to that, Lisa, I don't remember if I sent you this link during our conversation earlier this week or last week. I forget which one it was. But you can go to the YouTube channel or our webinars, of course, and you could do a quick search in our videos. Oh, I'm sorry, folks. There we go. There we go. You do a quick search in our videos for 8 ways. What it's looking for is 8 ways to manage a profitable long call, I believe. There it is, 8 ways to manage a profitable long call. So there's different ideas there of applying spread positions to it, selling half to pocket that return, and then maybe rolling it up. So it goes through those different scenarios. You can see sort of the effects of this one example that we had for Austin's situation, where we sort of compared the new return and the new risk exposure by doing each of those potential 8 different adjustments on a profitable long call, and you can reverse that for the long put as well. Reverse the ideas. You're doing the same thing, but just naturally doing it in the opposite direction. All right, so Lisa, I hope that helps answer some of your questions related to the long call management and long call adjustments. Take a look at that full webinar. As I mentioned, it's also available here on the webinars page. I'm pretty sure under the option strategies view and on YouTube there. I probably will add it to your with the proper date. Oh, there it is. I'm sorry, it's from April. I thought it said June on it, but it's from April. There it is. 8 ways to manage the profitable long call, Lisa. Get some other ideas. See the comparison of how rolling up the call would benefit you, rolling it further out, compared to maybe some other ideas you haven't thought of yet or haven't considered with it making the long call adjustments. For Lisa, we'll go back in the same scenario. She says, what if the long call is not profitable? There are ways to manage the long call if it's going against you as well. There are other videos that are available on that. I think it's called Manage a Losing Long Call Position. Let's just take a look here. Let me see, let's just try losing. Ideas for managing a losing long call. There are scenarios that you could do, again, based on your expectation of what you might consider moving forward. This is a good one to look for. Ideas for managing a losing long or bought call. And that was just from 7 months ago. There's probably a couple more here. And we did do one on trying to use the stock repair against a long call position, which was one of the ideas we discussed in that webinar as well. Stock repair. I think I titled it, can I use a stock repair for a bought call that is down? This is just from last month. So that's another one you can look for. So I'll send you those links, Lisa, about managing the long calls that are down. And essentially, common ideas. Let's take a reverse here. I don't want to go that far, but I probably will. It's perfectly fine. No, I'll use ESI. Now let's just put in an ESI position. Let's say I bought the 25 January call on ESI about a month ago. A month ago would have been really profitable. I probably would have closed the thing beforehand. So it's cheap right now. It's at 45 cents. So let's say I paid $1.10 for it. That's pretty steep. Oh, wrong one. Pretty steep, $1.10 for this position, Lisa. And I've just bought one contract. And let's say we bought it back there somewhere when the stock was around $27, $28. Excuse me. All right, so I'm at a loss of 59% on this particular call. First things first, Lisa, I wouldn't still be holding this position. Just like we talked about with the debit spreads and the credit spreads, if I get near a 50% loss on my long call position, I'm probably closing it out before the loss gets too big. I don't want to let that loss go to 80%, 90%, or 100%. Same as what I don't want to do with the credit spreads or with the debit spreads. I'd have set an alert here at PowerOptions to notify me if the option had changed, position change decreased by 50%. And that would have been a red warning. Or if even the option percent change, is usually what I use, is be 50%. Both should trigger now when I set this. So I'd have those alerts set. There we go. So when that alert is triggered, notifying me that I've hit my upper or lower stop limit for the price of the option, I would have closed it out at that time most likely, rather than continue to hold it and risk going to a 60, 70, 80, 90% loss on my long call position. Very good. So are there any things I could do now? Well, I'm in a short time frame. I only have 42 days to go to expiration. I doubt I'm going to see any rollout opportunities in this scenario, but let's take a look. And this is a bad example to use because this is one of those stocks we talked about, like HPE, which only offers the 5-point strike differences because it doesn't have an average of 5,000 option contracts traded per day, and it's under $25. So we only see the 2.5-point strike differences. All right, so where am I at right now? I'm at a 59% loss on the position of the maximum, and I know if the stock stays the same price the next 42 days, I'm going to be at 100% loss, which I don't want to see. What are some things that might consider? Well, this is going to be tough because of the strikes that are available. And one thing I might consider if I had more time is trying to convert it into maybe a calendar spread. Right, so if this was 90 days out or something along those lines, what I may consider doing is trying to sell maybe the December 25 call. We're only 7 days away, so this is only going to be 7 or 8 cents, even if I get the midpoint. But nope, that wouldn't work. That wouldn't do it. Okay. I could roll the call up and out as long as I expected the stock to continue up. So I know I'm taking a loss on this one, but I could essentially roll it down and further out in time, the opposite of what we did. What is that going to do? That's going to increase my cost basis because I'm pocketing the loss, Lisa, on this one. And I'm paying into a further out premium. So we're going to realize that 59% loss, roll out to maybe the May 2250 at 310. All right. And so that is we're going to take a loss here of that 55.60 cents and be left with a long call position now with a cost basis of 350. So my break even at expiration is going to be 24.85. But I have now 160 days to go to expiration. And if I'm holding this May 2250 call now with a cost basis of 350, after pocketing the loss, realizing the loss, I should say, Lisa, rather than pocketing the loss. Now I have more time to do what? Evaluate maybe better calendar spreads in this case as a potential repair to start knocking down the cost basis of that position and trying to get into a profitable range here. I don't like this calendar spread because it gives me two ways to lose, however, and I've got to be very careful. Once it hits 25, probably going to have to roll this up to the 27.50, just as you would a standard covered call position. Let's close all that down for the time being. That particular one, that's just one of the ways that's discussed in those other webinars, Lisa. Another potential adjustment, let's go back to square one in this case, with our losing long call, is I could try to potentially create a butterfly position around it. What do I have? I have the long 25 call for January. It's probably not going to be any premium to do this with, though. So if I create a butterfly, what I might be able to do, I own this one. Maybe I can sell two of these and buy one of these. This looks horrible, by the way, because the bid-ask spreads, there's no bid. So this is a poor example, Lisa. The examples that we showed in that other webinar are much better. So anyway, what could I do? I could sell two here. I'm going to buy one further out of the money. Right? So I'm going to collect essentially probably about 40 cents, 20 cents a piece for this one, and this is going to cost me 25. Maybe I should put in just 30 and 20. Since this is further out of the money, the bid-ask spreads are very wide and odd. But let's just try it. So what am I doing? I'm going to sell two January 30 calls and get 60 cents. And I'm going to buy one January 35 for 20 cents. So I'm going to take 40 cents off of my cost basis. And this essentially creates a butterfly. Now, unfortunately, what did it do? It lowered the loss because that new credit I took in, Lisa. Instead of having the 110 exposure, I'm now down only to 70, but I am in the loss zone. My new upper break even is 25.70. I need the stock to move back up to this price. Whereas my break even on my long call that's still out to January was the 25 strike plus the $1.10, so it would be 26.10, right? Yeah, 26.10. So we've lowered the break even again by 40 cents, the net credit we just created. But if I expect it to recover in this case and move back up in this way, I'll be back in the profitable zone at 25.70. But what have I done? What is this total monetary requirement? Essentially what I did is I had the 25 and I created one bull call debit spread by selling one of those 30 calls. But then I also created a bear call credit spread by selling the other 30 call and buying our 35 strike call as well. Okay, so that puts me into a butterfly, iron butterfly, well, no, call butterfly position, I'm sorry. And so that's a repair that could be considered. It lowers the exposure and the loss to the downside, gets you up to a max profit, pretty reasonable of 430 here against the risk. If the stock is trading, though, only right at $30 in 42 days. This one would be an aggressive move. It'd be speculative because there's a low probability the stock could be trading at 30, and I had to fake the prices to give you a good risk graph. On most normal stocks, if you're looking at an Apple, Lisa, if you're looking at Tesla, if you're looking something along those lines, the butterfly repair is an approach. Or extending the time frame and using a calendar spread, or rolling it down and then converting to a calendar spread. Those are all ideas that might work, as well as potentially using the stock repair tool. But again, I'll send you those losing long call management links for you so you can see better examples and better comparisons of the different ways that it might be done depending on the situation, depending on the underlying stock, depending on how large the loss is. Just as before, though, personally, I usually close those positions if they hit 50% of the maximum loss. Now, sometimes I go against that. Why would I go against that? If I have a stock that suddenly completely fell out of bed, we had that Barry example where the winning call, we bought the 65 call back in November, and now it was up at an 84% profit, a profit of $340. If I was in the opposite scenario and Barry had crashed suddenly overnight when it was trading at 65, it suddenly opened at $58 and went down from there to 56. And I'm suddenly from nothing that I could see, and I'm at 90% loss on the position. I may try to manage it, but there's not much management I can do, and I'm at a 90 for a 5% loss. If I still have 20 to 30 days to go and I'm at a 90% loss from an unexpected event, I may just leave that open. If it recovers, not recovers, but if it even moves back 2 or 3% from this massive drop it had after things settled down a week later, 2 weeks later, that loss might only be 80. That sounds terrible, but it's not 95. It's less of a loss. So that's the only time I might leave a position open if it's beyond the 50% level. If something unexpected completely happened that could not be seen in the stock chart, could not be seen in the news, information, company information, or anything along those lines. Just that terrible, unexpected event for the stock, and it just completely falls out of bed. And I'm at a 95% loss, still with 20, 30 days to go. I may leave that open for an extended time just to see if it recovers at all. Maybe my 95% loss only becomes an 80 or 75. That's about the best I can hope for. Those repairs typically won't work in this situation when it's beyond a 70 or 75% loss due to a sudden event.